Looking for undervalued Canadian stocks to add to your portfolio? Trying to find Canadian stocks at a discount? I'll be breaking down 2 undervalued Canadian stocks to add to your portfolio right now. A lot of the popular stocks these days have zero profits and plenty of risk when it comes to future value. However, these 2 stocks have high profits, high revenue, and high potential for future value. Almost every stock has tanked from March 2020, so everything seems to be trading at a discount. But you want to buy good stocks that you can bank on their strength and ride the wave until an economic recovery. That's where these 2 stocks come in. Before I get started, please thumbs the video and subscribe to the channel for more content. Please remember to watch my previous videos on my favorite dividend stocks to buy and hold forever. First stock is Couchtard. They are a massive convenience store and gas station chain. They are considered the leader in the convenience store industry in Canada, US, and in Europe. They have around 9,500 stores in North America alone. 2019 was a record-breaking year for earnings for the company, and their goal by 2023 is to double their earnings from this previous year. That seems to be an ambitious goal considering how fun 2020 has been, but it seems to be like they're well on their way to meeting that goal. The ticker is ATD.B. Those Class B shares are the common voting shares. The Class A shares are held by founders, insiders, and large institutions. The stock is currently trading at $45.41 with a very low yield of 0.62%. However, you're not buying the stock for the dividends, although that's a minor benefit. You're holding for capital appreciation. But while you hold, you get an added benefit of a 5-year dividend growth rate of 28%, which is a little over 5% increase per year. This is considered a defensive stock, similar to grocery store chains. Even in tough economic times, they're able to grow their earnings while other companies and other industries are either losing or stagnating. Their earnings per share has grown 25% each year for the past 3 years. Not only that, they're following an aggressive growth strategy. So not only are they trying to organically grow and build their grocery store chains, but when entering new countries, they're trying to acquire small and large existing grocery store companies. Let's quickly go through some high-level, simple analytics. You want to look at the company's balance sheet. Assets are greater than liabilities. They own more than they owe. That's great. Breaking it down slightly, their cash is almost enough to cover all of their current liabilities. Ideally, I would want to see this cash balance higher, but if they have revolving lines of credit, they can easily draw to pay down any debts, so this looks good to me. My favorite, cash flow statement. Cash flow from operations is increasing, even in a recession. This is a good sign. Their normal activities can fund their short-term cash needs without having to draw down on debt. Let's take a look at their income statement. Revenues are down, which might be concerning, but considering this is a recession and market downturn, I'm okay with this. What's even better, look at the gross profit. It has increased. This means they sold less, but they're making more after expenses. This can be the result of many things, but obviously it's business synergy being realized and expense management, which is clearly paying off. I would like to come back to this company in 6 months and see the full 2020 results and do a more in-depth analysis. I might actually do this for all my picks. I might take one video and break them down completely for their annual report and not just their quarterly results. Regardless, Couchtard is a great addition to any portfolio. Apologies to my friends or subscribers in the US, this is listed on the TSX for now. The second stock I'm recommending is Metro, ticker symbol MRU on the TSX. Metro is a Canadian grocery store with over 626 grocery stores in Canada, a number that is quickly growing. The stock is currently trading at $59.95, a market cap of $15.1 billion, and a modest dividend yield of 1.5%. Again, you shouldn't be buying this and relying solely on the dividend. Currently, it almost covers inflation, but you'll be holding the stock for capital appreciation, and consider the dividend a little bonus for your patience. Not only do they pay a small dividend, but they've been increasing this dividend payment for 26 years straight. Taking a look at the 1-year chart, the stock hasn't been struggling at all. Again, similar to Couchtard I recommended earlier, this is a defensive stock. They perform better than other industries and companies during tough economic times. They're a grocery store, they'll always be needed. Taking a look at their most recent financial statements, their earnings per share is increasing by 20% compared to the same period last year. Same-store grocery sales increased by 15.6%. Same-store is a financial metric that retail companies use to measure performance. It refers to the sales from stores that have been operating for a year or more. You can't buy 100 new stores and say your sales increased 1,000% compared to last year. That's not an apples-to-apples comparison. The financial metric same-store helps investors differentiate between existing growth versus acquisition-based growth. Back to that same example, the same stores that were earned last year had a 15.6% growth in sales, even with 6 of those months during a recession. Not only are they experiencing heavy growth in physical store sales, but they're adapting to the times and greatly expanding their online shopping and shortening delivery times to meet the added demand. Let's do some quick high-level analysis. Assets almost 2 times higher than liabilities. That's good. They own more than they owe. Cash isn't enough to cover current liabilities, but taking into account their undrawn credit facilities, this is a non-issue for now. Cash flow is looking good as well. Almost $1 billion this year in cash from operations. Not only that, but it seems to have almost doubled from the prior year. Their normal operations are more than enough to fund the business as well as pay down debt or expand the business. Lastly, income statement. Their net earnings around $600 million this year, 10% higher than last year. These are all good signs of a healthy business. Again, not doing a very deep dive on their analytics and their financial statements. Not going to spend another 10 minutes on this company, but if you want to invest in one of the best companies on the TSX, you have to add Metro to your list. Thanks for watching, guys. Please watch my previous videos on my stock recommendations, wherever they are, and let me know of any other stocks you'd like me to review. If you're new to investing and new to dividends, please check out my older video on how to invest in stocks and what the stock market is. And please check out my 2-part dividend series introducing dividends to the world. Thanks, guys.